Welcome back to our SAP journey. In the previous chapter, we completed the production process and placed our finished goods in stock. Now it's time to focus on the order-to-cash process, where sales activities begin and financial integration plays a crucial role. In this unit, we'll explore how customer sales orders are created, how these orders progress through delivery and invoicing, and how they impact financial reporting. By the end of this section, you'll understand how the system tracks revenue, taxes, and receivables, ensuring transparency across the entire sales process. Let's dive in and see how SAP seamlessly connects logistics and financial accounting to provide an accurate and reliable flow of information. Now that we're back at the main Fiori launchpad, we can see the tiles related to the plan-to-produce processing process. This is where we completed the production phase and stocked the finished goods. Let's move forward to start handling sales activities. Next, we select the order-to-cash processing area. This section provides all the applications needed for managing sales orders, deliveries, and invoicing. This marks the beginning of our sales process for the finished goods. In this step, we open the Manage Sales Orders application. This is where we can input new sales requests or review existing orders. Let's continue by initiating the creation of a new sales order. The system now displays the Manage Sales Orders interface. Here we see an overview of sales orders, providing visibility into customer-related data and sales transactions. To create a new sales order, we select the Create Sales Order with Validity option from the Create drop-down menu. This opens the form where we'll capture all relevant order details. The system prompts us to enter key fields, including the sales order type, sales organization, distribution channel, and division. Let's ensure that each field is filled out correctly before moving on. We've completed the form by selecting Standard Order as the sales order type, Sales Org Germany for the sales organization, and Direct Sales for both the distribution channel and division. After confirming the details, we click Continue to proceed. We now arrive at the main sales order screen. This interface consolidates customer, product, and pricing details to help us create the sales order seamlessly. Let's start by entering the customer's information. In the Sold to Party field, we begin typing the customer code. The system suggests matching entries, making it easier to select the correct customer record. Once the customer is selected, the system retrieves and populates the corresponding customer data. This includes key details such as the shipping address and other predefined conditions related to the selected customer. By autofilling this information, the system ensures that all relevant data is aligned for processing the sales order accurately. Here, we fill out the customer reference field. This field is used to capture additional customer-specific information, such as purchase order numbers or internal references. This step ensures that any important customer-related information is documented before proceeding. We now switch to the Items tab. This tab is crucial for specifying the details of the products or services to be included in the sales order. This transition prepares us for the next step, which involves entering product information. In this view, we start by typing the product code for our finished product. The system displays matching results based on the product master data, making it easier to quickly select the correct product to include in the order. Here, the system confirms the entered code for the finished product 001. This recognition step is vital because it ensures that the correct product is referenced in the sales order, minimizing errors. The next step involves entering the desired quantity of items for the order. In this step, we specify the quantity of items to be sold. We enter 10 pieces, which corresponds to the total available stock. This step is essential, as it defines the scale of the order and directly impacts inventory levels, revenue, and delivery details. In this screen, the system consolidates and displays all the relevant details of the sales order. Here's a summary of key points. Confirmed quantity. The system confirms the requested quantity of 10 pieces for the selected product. Item category. The item is classified as a standard item TAN, indicating its category within the sales order process. Net value.
The calculated net value for the sales order is €2,000, corresponding to €200 per unit of the product. To understand how the system determined the net value of €2,000 and its breakdown, we navigate to the pricing details screen. This allows us to analyze the individual conditions applied, confirming the reliability of the pricing calculation. This screen provides a detailed breakdown of the pricing conditions used to calculate the total value of the sales order. Price: the base price per unit is €200, which, multiplied by the quantity of 10, results in a total of €2,000. Net value calculation: the screen confirms that no discounts or additional charges were applied, keeping the net value consistent with the product's base price. Profit margin: the internal price is listed as €600, highlighting a profit margin of €1,400, ensuring transparency in pricing and profitability. Here, we save the sales order by clicking on the Create button. This action confirms that all relevant data, such as customer details, product quantities, and pricing conditions, has been successfully validated and recorded in the system. Saving the sales order finalizes this step and transitions us to the delivery and billing phases. Upon saving, the system generates a confirmation message displaying the sales order number, 1120, in the top left corner. This number serves as a reference for all subsequent processes. Now that the order is saved, we are ready to proceed to the next phase, creating the delivery document. This ensures the order is prepared for shipping and further financial integration. In this figure, we return to the main menu of the order-to-cash processing area. From here, we navigate to continue the sales process, ensuring a smooth transition to the next stage, outbound delivery creation. This step serves as a checkpoint before proceeding further. The next step focuses on selecting the Create Outbound Deliveries tile. This action initiates the process of creating delivery documents linked to the sales orders. It's a critical step in the fulfillment workflow, connecting sales activities to logistics operations. The system now displays the sales orders due for delivery. The list provides important details, such as the shipping point, planned creation and goods issue dates, and customer information. At this stage, we review and confirm the sales document, Sales Order 1120, before proceeding. At this stage, the relevant sales order is selected, ensuring that all prerequisites for delivery are met. The details displayed confirm the readiness of the order, including gross weight and shipment specifics. This validation step guarantees accurate processing before creating the outbound delivery. We now proceed by selecting Create Deliveries for the chosen sales order, 1120, as displayed on the screen. The delivery document serves as the connection between the sales order and the logistical handling of goods. While no physical movement of goods occurs at this point, creating the delivery document is necessary to enable subsequent steps in the logistics process. This document allows for operations such as picking, packing, and issuing the goods. Additionally, the system maintains traceability by generating a log for each delivery document created. The delivery log overview confirms the creation of the delivery log with the number 3864. This log includes key details, such as the assigned delivery number 800000631, visible in the Deliveries section. The status of the delivery is shown as open, indicating that although the delivery document has been created, further actions such as picking and goods issue are still pending. This step documents all necessary details for the outbound delivery and establishes the foundation for completing the logistics workflow. In this step, we navigate back to the main order-to-cash processing menu. This transition ensures that we are positioned to carry out the next steps, focusing on the outbound delivery process. Returning to this menu helps establish a structured workflow for managing subsequent logistics tasks. Next, we select the Pick Outbound Delivery tile from the menu. This step is essential, as it prepares us for interacting with a specific delivery document and performing the goods issue process. The system presents the delivery search interface, allowing us to input the outbound delivery number. This ensures that the correct delivery document is retrieved. In this step, we enter the delivery number 8000631 into the search field. This action guarantees that we access the correct delivery document, which has already been picked and packed by the logistics team. The delivery header screen provides an overview of key details, such as gross and net weights, the planned goods issue date, and the picking status. To streamline our process and focus on the accounting aspects, the picking operation has already been completed by the logistics team. This allows us to proceed directly to posting the goods issue, ensuring all relevant data is ready for review and further processing. By selecting the Post Goods Issue button, we finalize the goods issue posting. This step is essential for recording the removal of goods from inventory and ensuring that the system reflects this change accurately. The system generates the material document 4900004077 upon successful posting of the goods issue. This document confirms the completion of the process, updating the delivery status and completing the outbound logistics workflow. Here, we return to the main menu in the Purchase to Pay processing section. Our goal is to review the financial documents generated by the goods issue. From this screen, we will navigate to the next step, focusing on the material document overview for detailed analysis. In this step, we select Material Documents Overview from the menu. This option allows us to access all material documents associated with the goods movement, including those generated during the goods issue process. In this screen, we use the material code to search for relevant documents. The system displays 2 material documents for the selected finished product. The document starting with 5 corresponds to the goods receipt from the production order to stock, while the document starting with 4 reflects the goods issue for sales, which we processed earlier. This distinction allows us to trace the complete flow of the material from production to sales effectively. By selecting the material document starting with 4, we open the details of the goods issue document. This document provides essential information regarding the movement of goods out of inventory for sales purposes. In this view, we can see detailed information about the goods issue. The document highlights the inventory movement, specifying the material, quantity, and storage location involved. These details ensure accurate tracking and reporting within the system. This screen presents the process flow of the material document. It visually maps out the sequence of steps, including the delivery, material document, and accounting entries. This flow is a new functionality that helps users understand the link between logistical and financial processes. Here, we click on the accounting document linked to the material document. This action opens a pop-up with options to explore further details. We focus on the Manage Journal Entries option to proceed. In this step, selecting Manage Journal Entries allows us to access the financial postings associated with the goods issue. This is a critical step to understand how the goods issue impacts financial records. This screen provides an initial view of the journal entry created for the goods issue. It records the debit of €600 to the cost of goods sold account, representing the cost of the sold product, and the corresponding credit of €600 to the finished goods inventory account, reflecting the inventory reduction. This entry is pivotal in linking the inventory movement with financial records and ensures accurate accounting for the sales transaction. In this final view, we analyze the journal entry in the T-account format for better clarity. The debit entry of €600 to the cost of goods sold account confirms the recognition of the cost incurred for the sold goods. Simultaneously, the credit entry of €600 to the finished goods inventory account reflects the reduction in inventory value. In this screen, we revisit the process flow to focus on the second accounting document generated. This visual representation emphasizes how the material and accounting documents are connected to the delivery. Notably, the presence of 2 accounting documents highlights the splitting of financial postings across different cost components, which we will further analyze. By selecting Manage Journal Entries, we can access detailed insights into the second financial document. This step is essential for understanding how the €600 cost from the goods issue is divided across multiple accounts, reflecting various cost components such as materials, labor, and overhead. This screen provides a detailed breakdown of the journal entry, illustrating the splitting of the €600 cost of goods sold into its individual components. The first line represents an offset or reversal entry of the total amount recorded in the previous journal entry. This reversal is essential as it prepares the system to allocate the costs accurately. The following lines detail the splitting of the €600 based on production costs. €300 attributed to direct material costs. €200 allocated to labor costs. €100 assigned to machine costs. This structured breakdown reflects a granular view of cost allocation in the production process, enhancing financial reporting accuracy. By breaking down the costs into their respective components, this step provides insights into the cost structure and supports both financial and managerial accounting for profitability analysis and decision-making. Here, we navigate back to the trial balance report that we had previously opened. This step reconnects the specific journal entries we reviewed earlier with the broader financial data in the system. By doing this, we ensure that the updates made in the journal entries are accurately reflected in the overall report. In this figure, we observe the trial balance before refreshing the data. This view allows us to confirm that no updates are yet visible from the journal entries. It provides a baseline for comparing the pre-update status with the refreshed data. Now, we refresh the trial balance report to load the latest data. This action ensures that all recent journal entries are included in the report, reflecting the most up-to-date financial information. After the refresh, we can now clearly see that the system has split the total cost of goods sold COGS, amounting to €600, into 3 separate ledger accounts. These accounts include direct material costs, €300, personnel time costs, €200, machine time costs, €100. This breakdown shows how the COGS amount is allocated across multiple accounts, providing a detailed view of production cost distribution. This step aligns the logistics process with financial accounting, offering deeper insights into the financial structure and reporting. At this stage, we continue within the order-to-cash processing app. Here, the system displays available functionalities, such as managing sales orders and creating outbound deliveries. This is where we prepare to proceed with billing by identifying the necessary app to create billing documents. Now we navigate to the search bar within the Order-to-Cash Processing app to locate the Create Billing Documents application. Typing the app name streamlines access, ensuring we can directly proceed to the next step of the billing process. Here, we entered the Sold to Party field to specify the customer for whom the billing is being prepared. After this input, the system automatically proposed the delivery document associated with this customer that is ready for billing. In this step, we proceed by selecting the delivery document displayed. This selection confirms the delivery that will be processed into a billing document. By focusing on the specific document, we streamline the transition to the billing stage. By selecting the Create Billing Document option, the system generates a temporary invoice. This step marks the transition from delivery to billing, enabling us to preview the document before finalizing the process. This screen provides a detailed view of the generated temporary invoice. It includes all critical elements, such as the customer details, net value of €2,000, and tax amount. This temporary status allows for review before making the invoice permanent. Here, we explore the accounting data tied to the temporary invoice. The system ensures that all relevant fields, such as pricing details and assignments, are correctly populated. This step is essential for accuracy before moving forward. The process flow visualized here summarizes the journey so far. It outlines the sequence from order creation, delivery, and the newly created temporary invoice. This provides a clear overview of the completed steps, ensuring transparency and process validation. Here we have reviewed the details of the temporary invoice, and it is now ready to be finalized in the system. By selecting the Save button, we ensure that the invoice transitions from a temporary status to a permanent one, securing its place in the financial records. Once saved, the system updates the process flow to indicate the completion of the invoicing step. This visual representation connects the prior stages, order processing, delivery, and invoicing, highlighting the seamless progression toward accounting. At this point, we select the journal entry related to the completed invoice. By clicking on the link, the system displays a pop-up that allows us to dive deeper into the accounting document, providing a detailed view of the financial impact of the transaction. In this view, we can observe the detailed journal entry generated from the invoicing process. The document includes the breakdown of accounts affected, such as revenue, accounts receivable, and taxes. Each line item is clearly identified, along with its respective debit or credit values. In this detailed T-account view, we can clearly observe the financial impact of the transaction. The breakdown includes the following key accounts and values. Accounts receivable, a debit entry of €2,200, representing the total amount to be received from the customer. Output tax, a credit entry of €200, corresponding to the tax calculated on the invoice. Revenue, a credit entry of €2,000, capturing the net sales revenue generated from this transaction. This view provides a concise yet comprehensive perspective of the journal entry, ensuring accuracy and traceability of financial data. The seamless integration between modules emphasizes the system's efficiency and reliability, giving users a positive and insightful experience while navigating this screen. We are transitioning back to the trial balance report to validate the accounting impact of the journal entry. By switching views, we ensure that the system accurately reflects the financial updates in a consolidated manner. This step connects the detailed journal entries to the broader financial reporting perspective. Here, we observe the initial state of the trial balance before refreshing the data. This view shows the account balances prior to incorporating the financial results of the invoice posting, serving as a baseline for comparison. After refreshing the trial balance, the updated balances are displayed. This step incorporates the journal entry values into the report, ensuring that all financial changes are accounted for. This action confirms the seamless integration of the transaction into the financial system. The final view highlights the key account balances affected by the transaction. The revenue account shows a credit of €2,000, the tax account displays a credit of €200, and the receivables account reflects a total debit of €2,200. These values confirm the proper allocation of the transaction's financial impact, aligning with accounting standards and ensuring accurate financial reporting. Now, we return to the Home menu. Here, we can access the shortcuts saved earlier during our initial configuration. These shortcuts allow us to quickly execute predefined parameters without repeating manual entries, ensuring efficiency in generating financial reports. Let's proceed to use our saved shortcut to generate a financial statement. Using the predefined parameters saved earlier, we execute the task to generate the financial statement. This automation streamlines the process by leveraging saved configurations, allowing us to focus on analyzing the results once the report is generated. Here, the system displays the balance sheet, summarizing the financial position of the company. The report includes assets, liabilities, and equity for the selected period, providing a high-level view of the organization's financial health. This overview is essential for stakeholders to understand the company's performance. To further analyze the report, we select the option to download the PDF version of the financial statement. This format enables detailed offline review and sharing with stakeholders, ensuring comprehensive understanding and communication of the financial results. Before diving into the report, it's important to understand that we are analyzing a balance sheet, which is divided into two main sections: assets and liabilities. Assets represent everything the company owns or expects to receive, while liabilities reflect its obligations or amounts owed. Additionally, within the assets section, there are subtotals and hierarchical classifications to organize the information clearly. Let's break down the balance sheet together and understand the key financial details. We start with the assets section. This represents everything the company owns or expects to receive. It's divided into key categories to provide a clear overview. First, current assets, totaling €1,400. This includes the resources the company can quickly use to cover its short-term obligations. Let's take a closer look. Item I, stocks, the company holds €2,700 worth of raw materials. These materials are crucial for production, as they will eventually be turned into finished goods. Next, Item 2, Receivables and Other Assets, totaling €2,310. Here's the breakdown. Accounts receivable, €2,200. This amount represents money the company expects to receive from customers. Input tax, €310. This reflects taxes the company can recover. Output tax, -€200. This is the tax the company needs to pay. Finally, Item 4, Checks, Cash on Hand, Deposit. The balance here is -€3,610. This negative figure shows that the company is using an overdraft facility or has a cash deficit. This is common for businesses managing cash flow actively, but it's something to watch closely. When we sum these amounts, we get a total of €1,400 for current assets. This value accounts for the raw materials, expected receivables, and the impact of the cash balance. By reviewing each line, we can see the company's liquidity position and the importance of turning receivables into cash to support ongoing operations. Liabilities section. When we analyze the liabilities section of the balance sheet, it generally includes the obligations the company has. These obligations can be amounts the company owes to suppliers, banks, or other entities. However, in this specific report, the only item listed under liabilities is the company's profit, which might seem unusual at first. Let me explain why. At the end of the accounting period, the company's profit, meaning the net positive result of its operations, must be documented somewhere. The reason it appears under liabilities is that this profit doesn't entirely belong to the company itself. Instead, it represents an amount that belongs to the shareholders or owners. This line is referred to as balance sheet profit and is treated as something the company owes its shareholders. Why? Because this profit will eventually be distributed as dividends or reinvested into the business, benefiting the shareholders. From an accounting standpoint, it's recorded as an obligation, as if it were a financial responsibility. In this report, we see that the profit is listed as -€1,400, reflecting that all earnings for the period have been accounted for and noted as a liability. Now that we have explained the assets and liabilities, let's move on to the final section, the profit and loss statement and profitability. The revenue recorded is €2,000. This value represents the total income generated by the company from the sale of products during the reporting period. It is registered under the account Revenue Domestic Product. Next, we look at the cost of goods sold COGS, which totals €600. This includes direct expenses related to producing the goods. Before being recorded as COGS, these amounts are processed through the production order. Initially, they are posted as debits for material consumption, machine usage, and payroll expenses. Once the production process is completed, these debits are cleared with a credit, transferring the total cost to inventory. By comparing the revenue of €2,000 with the total production cost of €600, we calculate an operating profit of €1,400. This result reflects the company's production efficiency and is carried forward to the balance sheet as part of the company's financial position. This breakdown provides a clear view of how revenue and costs contribute to the overall profitability, ensuring transparency and facilitating accurate financial analysis.
Welcome back. Let's take a moment to recap everything we've covered so far in the order-to-cash process for stock product sales. In this unit, we walked step by step through how a sales order is created for a product in stock. We began by identifying the customer and selecting the appropriate items from inventory. Once the sales order was completed and confirmed, we proceeded directly to the outbound delivery phase. We saw how the system processes the goods issue, ensuring accurate tracking of stock levels and correct financial entries. This step was key to updating the inventory balance and recording the corresponding financial movements. From there, we transitioned to billing, where the system generated a temporary invoice, allowing us to review all details before finalizing it. Once everything was validated, we posted the final document, updating the financial records accordingly. Finally, we reviewed the profit and loss statement, focusing on the key figures: revenue, cost of goods sold, and operating profit. This provided us with a clear understanding of how the sale impacted the company's financial performance and balance sheet. This comprehensive overview of the order-to-cash process for stock product sales sets the foundation for our next step. What's next? In the next unit, we'll shift our focus to service sales. This will allow us to explore how the process changes when handling sales that don't involve inventory movements but still require robust financial and operational controls. Stay tuned as we dive into the order-to-cash process for service sales. It's going to be an exciting expansion of what we've learned.